What? Oh.
Yo, what's up, bro?
Hello.
What?
Hey, might need a little bit of salt, Kalium. Yo, what's up? Nice, nice.
Are you just here just to do it?
What's up, bro?
Are you here for the, what's it called? The hidden bunker?
Not really, but I mean, I'll join you.
Oh, I'm just here just to see if I can get anything. I've already completed it.
Oh, you completed it already?
Yeah, I've already finished it. Because you get 9,600 points out of it completely. I've already finished it.
Oh shit, how do you do that, bro?
Through the trial, if you hit start and go over to the module, where it says trial, the one that says, where is it? Download the information inside.
Oh, okay, okay. I see the list now.
See what I'm talking about?
Yeah, I see it. Yeah, I see it, bro.
Yeah, so that is directly below the departure building.
Oh, for sure.
Once right now, it's all for Tesla. Everybody goes there, and you start gathering information from like little computers that you go there, and that's how you do the channel.
Oh, okay, for sure. I'm gonna go do that.
No.
All right, you too, bro.
Attention Raiders, the south antenna has just been activated.
Yo. Wow.
Attention all Raiders, the west antenna has been successfully activated.
Yo, what's up? Hey, bro, do you know how to do the trial?
Attention Raiders, the
Is
north
it good?
antenna has been activated.
Alright. Yo, what's up, bro?
told you the bond market just did something that only does right before a market crash. The grinding part. These signals preceded both the dot-com bubble and the global financial crisis, and brought out 44%. Now stay tuned because investors eagerly buy every dip. The treasury market right now is sounding the alarm that stocks are about to crash. I'm going to break down the exact signals, their historical context, and show you how this all-time factor is going right now in the labor market and the services sector. And more importantly, I'm going to show you exactly what you need to do right now to protect your money and profit from this next crash. And speaking of profit, on Christmas Eve, we alerted our CTA Time Pro subscribers by South Korean stocks, and they just cashed in a 26.23% gain in just 25 days after we got stopped out. We're already on to our next big trade as we've rolled out some major improvements to our trading system that are driving bigger win rates, higher returns, and smaller drawdowns. Now, you need to lock in the price before it goes up. Hit those links in the description below for your free 30-day trial. Stay tuned to the end of the show for more information. Now, stay with me because the markets are starting to unwind, and I don't want you to go down with it. Let's dive in because the yield curve is indicating that liquidity is drying up and that financial conditions are tightening rapidly, as you're about to see. If that happens, stocks crash. Now, the difference between the 2 and 10-year treasury bills is currently sitting right around 69 basis points, closing in on a 4-year high of 74, reached back in April of 2025, as you can see on this chart of the 2-10s yield curve. And what's been pushing 10-year yields higher is uncertainty about debt sales. And then there's Kevin Warsh's nomination for Fed chair, who's previously indicated he wants to reduce the Fed's balance sheet, telling the market that every sign means that intermediate and long-term rates are likely to go up. But 2-year treasuries, which are more sensitive to Fed policy and financial conditions, say just the opposite. They've been slowly declining since January of 2025. And this steepening of the yield curve driven by a rise in long-term rates is known as a bear steepener. It's typically interpreted as a sign of mounting fiscal pressures. Now, from a market perspective, this is totally bearish, hence its name, as it leads to higher borrowing costs, which President Trump has said is the biggest problem holding back the economy right now. But a bear steepener, it has the potential to weaken economic growth, tighten financial conditions, and as you're about to see, send stocks crashing. Now, let's dive in deeper to why the yield curve is indicating that stocks are about to crash. And I'm going to show you how this all ties back to the labor market and services sector, and what Treasury Secretary Scott Bessent is attempting to do right now to prevent this unwind from happening. Because the charts, well, they tell the whole story. Let's start with a big picture, then we're going to zoom in. Now, we're going to swap 2-year treasury bills for 3-month yields. Instead of the 2-10s curve, we're going to use a 3-month 10-year. And what I want you to see is that when 3-month yields fall and the yield curve is rising, recession usually follows. Now, why are we switching to 3-month yields here? Because treasury bills are the most sensitive to financial conditions. Now, when liquidity gets scarce and financial conditions tighten, bill yields will lead 2-year yields, as you can see in this next chart of 3-month treasury bill yields in blue versus 2-year treasury bills in red. Now, let's look at how this leads to a stock market crash. First up, let's take a look at the dot-com bubble. You can see back in October of 2000, the 3-month bill yields, shown in red, started to fall at a faster rate than 10-year yields. And you can see that in the yield curve that's in black. The S&P 500, it would drop 47% off its highs. Next, let's take a look at the global financial crisis. You can see in January of 2007, the 3-month bill yield, shown in red, again, started to fall at a faster rate than the yield curve, again, still in black. The S&P 500 would go on to drop 56% off its high. The last time this happened, well, was going into COVID. And you can see that in May of 2019, the 3-month bill yield, still showed in red, started to fall at a faster rate than 10-year yields. That meant the S&P 500 was going to drop 30% off its high. So now you've seen that this relationship in the treasury market has front-run every major market drawdown in the last 25 years. Let's take a look at where we're at right now. And you can see in this chart of 3-month treasury bill yields in blue versus a 3-month 10-year yield curve in red, that starting back in June of 2024, that bill yields started to fall at a faster rate than 10-year yields. And so while both the S&P 500 and the NASDAQ 100 rallied since the June of 2024, over the past 2 to 3 months, what have we seen? Momentum, it's died out. Liquidity, it's drying up. And the stock market right now looks more likely to crash than it does to rally. Now stay with me because I want to show you how this ties right back into the labor market and the services sector. Because payrolls, Well, they're pretty weak. ADP reported that private sector payrolls increased by 22,000 after a downward revision in the prior 2 months. Now, here's the big problem with that. The economy needs to create 100,000 jobs a month to deal with population expansion and retirements. On top of that, we have 2 months of downward revisions. That's not a good trend. So in reality, we're barely creating any jobs. The labor market hit a wall as the economy has barely added any jobs since April as of last year, according to the BLS. In annual revisions, they're likely to push 2025 aggregate job growth into negative territory. And as a result, part-time work is now on the rise. The number of employed part-time for economic reasons hit 5.34 million. That's the second highest since 2021 and way above the 2001 recession. The bottom line here, there just isn't full-time work available. More companies that we're hearing every day are indicating that they're going to be laying off. And when the official report hits, it could be ugly. The BLS's January jobs report should be rescheduled soon now that the shutdown has ended. And that release will also include revisions to annual payrolls, which are expected to show much slower job growth in the year through March of 2025 than initially thought. Stocks, they're not going to like that report. And here's the proof in this next chart of employment level. That's part-time for economic reasons in blue versus the NASDAQ 100 in red. And you can see when part-time work rises, stocks fall each and every time. Now, before I show you what's going on in the services sector, I need to show you something from the S&P Global Manufacturing PMI. Because what's going on there, it's totally unsustainable. Production growth is significantly outpacing that of new orders to the greatest extent since the global financial crisis back in early 2009. This highly unusual situation is clearly unsustainable, hinting at risks of a production slowdown unless demand improves markedly in the coming months, which based on the recent layoff announcements, seems highly unlikely. And as of the moment, service employment has stagnated. The ISM reported that after a positive jump in services employment for December, it's flatlined again at 50.3. But that's not going to hold. Let me show you why. Because it's all coming down to one thing: backlogs. Backlog of orders index was in contraction territory for the 11th consecutive month, with respondents saying, quote, "We've been able to order more raw materials and clear up our backlog." So all of a sudden, what are we likely to see? Is those backlogs are going to get cleared out. Once the backlogs are gone, then workers are next. And this is why we're seeing more companies right now laying off middle managers, because they need their workers, but not for a whole lot longer. And what this is causing is panic all the way at the top, which is why Bessent is worried. Now keep in mind, Treasury Secretary Scott Bessent is a former hedge fund manager, so he knows the bond market, he knows the economy, and he knows the relationship between the two. And in his so-called quarterly refunding statement on Wednesday, the department said it anticipated keeping auction sizes unchanged for nominal notes, bonds, and floating rate notes, at least, quote, for the next several quarters. Translation, we're going to keep flooding the market with bills in hope to keep short-term rates up. At the same time, we don't want to do anything to cause long-term rates to go up. So now you've seen how a bear steepener has predicted every single recession and market crash over the past 25 years, and is signaling again one right now. Making matters worse, the labor market is weakening as more full-time jobs are lost and more workers are seeking part-time employment. It's also a leading indicator of an imminent stock market correction. In factory production right now, it's unsustainable without a huge influx of new orders, and unless services demand surges. Once those backlogs are over, layoffs are going to jump. And then regardless of what Bessent does right now, it's game over for the economy and the markets. Now, if you want to profit on the bull steeper, it's not too late to act, but the clock is ticking. You could already see the weakness in the tech stocks over the last few days. So here's what you can do right now. You can diversify out of banks, technology, and cyclical stocks into defensives like utilities and healthcare. As far as gold and silver, hold off until a bottom is confirmed. Now for the pros, and I'm talking only of those with the risk tolerance experience in the stomach, look to be tightly short the major indices, especially big tech here. And how about Jeffrey Gundlach, the bond king, recommending a minimum of 20% of your portfolio in cash. And if we see another 40-some% drawdown, you're going to wish you had even more cash to buy the dips. Based on what we're seeing in the bond market, the next one could be the big one. Instead of cash, we want to consider short-term treasuries. As far as the long bond, hold off for now. Even though we know it follows short-term rates, not there yet. So now you've got your roadmap for profiting on a bull steepener. That is, if you choose to use it. And speaking of trading risk into wins, remember that EWY trade I mentioned at the top? My subscribers just cashed in a 26.23% gain in just 25 days after we got stopped out. Let's talk about how we do it, how you too can swing trade your way to big profits in 2026. Now, one of the key things about that trade, it had an expected win rate of 87%. Now, how did we know that? What do we do? Well, each and every day we look at the machine positioning across the broad equity, bond, currency, and commodity markets. And what we're looking to do is position our subscribers ahead of a big wave of machine buying and get them out before the machines sell. Now, these machines, they trade based on threshold levels. But what we've done is we've gone through and optimized and backtested them. So we know exactly which threshold levels have the biggest win rate, has potential for return. That's the benefit of a fully optimized strategy. You get a higher total return, a better win rate, and a smaller drawdown. It is so easy to use. Every day you're going to log in, you're going to scroll down to the latest report, and in there you're going to get an update on our existing trades. You're going to get all the recommended trades for that day, including full risk control levels, plus every signal generated on the long and the short side by our optimized trading strategy. So you get all the tradable signals, you get my opinions on the best trades, you get full risk control levels, a tracking of all open trades and returns, the weekly update, and here's the best part. Whether you're brand new to trading or you're a seasoned trader, we're so convinced that our system is better, we want your first 30 days to be on me. All you need to do, grab those links in the description below and use the coupon code FREEGORD for your 30-day trial. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.